72 hours ago, the Federal Reserve quietly injected $17 billion to rescue major banks drowning in silver losses. This is not a bailout you will see on the news. This is not something Congress voted on. This is a silent rescue operation happening right now while you watch grocery prices climb and your savings lose value. Here's what nobody is telling you. Banks bet heavily that silver prices would fall. They were wrong, catastrophically wrong. Now they owe silver they do not have at prices they cannot afford. And instead of letting these banks face the consequences of their own mistakes, the Federal Reserve is printing $17 billion to save them. But here's what makes this different. China has set a trap, an 80% premium trap, and American banks walked right into it. By the end of this video, you will understand exactly how China engineered this crisis, why the Federal Reserve has no choice but to keep printing money, and most importantly, who is really paying for all of this? Spoiler, it is you. Let me show you how deep this goes. The $17 billion facility appeared in Federal Reserve balance sheet data on January 5th. No press release, no announcement, just a line item buried in the weekly H41 report that most people never read. The facility is officially called a temporary liquidity accommodation for commodities market participants. That is Fed speak for bailing out banks that bet wrong on silver. Here is what happened. Multiple major banks, including divisions of JP Chase, Goldman Sachs, and Morgan Stanley, sold silver short. Selling short means betting prices will fall. You sell something you do not own at today's price, planning to buy it back later at a lower price and pocket the difference. These banks sold hundreds of millions of ounces worth of silver contracts at prices around $30 per ounce. They assumed silver would drop to $25 or $20. They would buy back at the lower price and make billions in profit. Except silver did not fall. It rose, and then it kept rising. Now silver trades at $37 on paper markets. But here's the critical part. If you actually want physical silver, you cannot get it for $37. You pay $50 to $60 per ounce in Western markets. In China, you pay closer to $70. The banks are trapped. They owe silver at $30 but cannot buy it for less than $50 or $60. Every dollar silver rises costs them billions more. Their losses are mounting every single day. This is where the Federal Reserve stepped in. The $17 billion facility provides loans to these banks using their other assets as collateral. Think of it like this. The banks use their government bonds and other holdings as IOUs to get cash from the Fed. That cash keeps them alive while they figure out how to escape their silver positions without triggering total collapse. The loans are cheap, below market interest rates, flexible repayment terms, generous collateral valuations. Everything is designed to minimize pressure on the banks. This is not capitalism. This is not a free market. This is the Federal Reserve protecting institutions that gambled recklessly and lost. But here's what makes this even worse. The real story is not the $17 billion. The real story is why these banks are trapped in the first place. And that story starts in China. China engineered this crisis with surgical precision. Let me walk you through exactly how the trap works. On January 3rd, China suspended export licenses for all 44 companies authorized to ship silver out of the country. No warning, no negotiation, just immediate suspension. That cut off 18% of global silver supply overnight. But China did not stop there. They also started manipulating their domestic market to create what I call the 80% premium trap. Here's how it works mechanically. On COMEX, the main commodities exchange in New York, silver trades at around $37 per ounce right now. This is the official global spot price. This is what banks use for their contracts and calculations. But in Shanghai, physical silver is trading at $65 to $70 per ounce. That is an 80% premium over the COMEX price. Let me repeat that because it is critical. The same ounce of silver costs $37 in New York on paper, but $70 in Shanghai in reality. Why does this premium exist? Because China is deliberately creating it through three mechanisms. First mechanism, government buying. Chinese state-owned enterprises are buying silver aggressively on domestic markets. This creates artificial demand that drives prices up. The government is using public money to inflate its own silver market. Second mechanism, export ban. Silver cannot leave China. So if you are a Western company that needs silver for production and Chinese supplies are your only option, you have to pay Chinese prices. You have no alternative. You pay the premium or you stop production. Third mechanism, import restrictions. China also quietly tightened rules on silver imports. Silver cannot easily enter China either. This isolates their market completely. They control both supply and price within their borders. Now let me show you why this creates an impossible trap for Western banks. Imagine you are a Chinese electronics manufacturer. You need 1,000 ounces of silver today for your production line. You have exactly two choices. Choice 1, buy from Chinese domestic suppliers at $68 per ounce. Total cost, $68,000. You get the silver immediately. production continues. Choice 2. Try to import silver from overseas at the COMEX price of $37. But wait, import licenses are nearly impossible to get. Processing takes weeks or months. Your production stops while you wait. You lose contracts. You lose customers. So you pay $68, you have no real choice. Now multiply this across thousands of Chinese companies. They are all paying premiums of 60 to 80% above global spot prices. This keeps Chinese domestic silver prices artificially high. But here is where the trap closes on Western banks. Those banks sold silver short based on COMEX prices around $30. They hedged their positions using derivatives and also priced around $30 to $33. Their risk models assumed they could always buy physical silver within a few dollars of spot price if they needed to. That assumption is now completely broken. Physical silver in accessible markets costs $50 to $70. The banks cannot close their short positions without taking massive losses. Every contract they have to fulfill bleeds money. And here is the brilliant part of China's strategy. They know Western banks are trapped. They know the Federal Reserve will have to intervene. They know this intervention requires printing money. They know money printing causes inflation. They know inflation hurts regular Americans while banks get rescued. China is watching America destroy its own currency to save reckless banks. And they are creating the conditions that force exactly this outcome. If this makes you angry, let me know in the comments, because it gets worse. The Federal Reserve had no good options, but they made a choice. And that choice tells you everything about whose interests they really serve. Option 1, let the banks fail. Let them liquidate their silver short positions at massive losses. Some banks would survive, some would not. Markets would experience severe disruption. But eventually prices would stabilize, Z and normal function would return. The Federal Reserve rejected this option. They decided bank stability was more important than market discipline. Option 2, force banks to raise private capital. Make them go to shareholders and bondholders. Dilute existing equity. Impose losses on people who invested in these institutions. The Federal Reserve rejected this ion 2. They decided that protecting bank shareholders and executives was more important than making private investors bear private losses. Option 3, create a lending facility that provides cheap money with minimal conditions. Let banks maintain their losing positions indefinitely. Hope silver prices eventually fall and the problem solves itself. If prices do not fall, expand the facility later. This is the option the Fed chose. It is the path of least resistance. It avoids an immediate crisis. It protects existing power structures. It delays consequences. But it creates huge problems. The $17 billion in loans is not sitting in a vault somewhere. That money enters the economy. It increases the money supply. More money chasing the same amount of goods and services means higher prices, means inflation, means your dollars buy less. The Federal Reserve knows this. Their economists understand the consequences. But they made a calculation. Inflation spread across all Americans is politically easier to manage than bank failures concentrated in financial markets. So they chose inflation. They chose to make everyone pay a little rather than make banks pay a lot. This decision reveals the true priority structure. Banks first, markets second, regular Americans last. The facility operates under an emergency authority that does not require congressional approval. The Federal Reserve can create it unilaterally. No votes, no oversight, no public input. This concentration of unaccountable power is historically unprecedented. Previous generations of Americans would not have tolerated it, but today it happens quietly while most people are not paying attention. Now I'm going to show you the part they're hiding. This is not the first time this has happened. This is a pattern. And recognizing the pattern is critical. You have seen this before. The faces change, the asset changes, but the pattern is always the same. 2008, banks made reckless bets on mortgages. Housing prices fell. Banks faced insolvency. The Federal Reserve and Treasury stepped in with $700 billion in TARP funds plus trillions more in emergency lending. Banks got rescued. Executives kept their jobs. Some even got bonuses. Meanwhile, 13 million Americans lost their homes to foreclosure. Private profits, public losses. 2020. Corporate America faced a cash crunch during pandemic shutdowns. The Federal Reserve created multiple lending facilities. They bought corporate bonds. They backstopped entire markets. $4 trillion in intervention. Corporations got rescued. CEOs maintained compensation. Stock markets hit record highs. Meanwhile, 40 million Americans filed for unemployment. Private profits, public losses. Now 2026, banks bet wrong on silver. China set a trap. Banks are facing massive losses. The Federal Reserve creates a $17 billion facility. Banks get cheap loans. Executives face no consequences. Shareholders are protected. Meanwhile, the regular Americans watch prices rise and savings shrink, private profits, public losses. Notice the pattern? Every single time, the same playbook. Banks and corporations take risks when times are good. They profit enormously. Then, when risks go bad, they get rescued with public money. The losses get socialized while the profits remain private. You pay. They win. This is not capitalism. In real capitalism, bad bets create losses. Losses force change. The threat of losses enforces discipline. This mechanism keeps the system healthy. But we do not have capitalism. We have a hybrid system. Profits are capitalist. Losses are socialist. The worst of both worlds for regular people. The Federal Reserve enables this pattern. Every rescue creates expectations of future rescues. Banks know they will be saved, so they keep taking excessive risks. Why wouldn't they? Heads, they win. Tails, you lose. This is called moral hazard. When institutions do not face consequences for bad decisions, they make more bad decisions. The cycle reinforces itself. Each crisis is bigger than the last because institutions learned from previous crises that rescue is always coming. The silver situation is following this exact pattern. Banks made bad bets. China exploited those bets. No, the banks get rescued. And the pattern continues. Here is what nobody in power wants to admit. This pattern cannot continue forever. Eventually, you reach a crisis too large to rescue. Too many institutions are failing simultaneously. Too much money is required. Too obvious to hide from the public. That breaking point might be years away. Might be months away. But it is coming. The math guarantees it. This next part explains why your money is at risk. Because you are the one paying for all of this. And let me connect the dots between Federal Reserve policy and your daily life. Because the connection is direct, it is costing you more than you realize. Your grocery bill is up 18% over the past year. You probably noticed. You are spending more but getting less. You might think this is just normal inflation or corporate greed. But here is the direct connection. When the Federal Reserve creates $17 billion to bail out banks, that new money enters the economy. Banks use some of it to cover margin calls. Some of it flows to counterparties. Some of it gets deposited in other accounts. All of that money eventually circulates through the system. More money supply, chasing the same amount of goods means prices rise. Your grocery store did not suddenly get greedier. Your dollar just became worth less. The Federal Reserve diluted your purchasing power to save banks. That 18% increase in your grocery costs? A significant portion of that is Fed money printing flowing through the economy. You're paying for the bank bailout every time you buy food. Now, let's talk about rent and housing. You cannot afford a house, or your rent keeps increasing. You might think this is just a housing shortage. But here's the mechanism. Federal Reserve money printing flows into asset markets. People with access to cheap credit buy houses and rental properties as inflation hedges. This drives up real estate prices. Landlords pass increased costs to renters. Young families get priced out of homeownership. The same $17 billion that rescued banks makes your housing more expensive. The Fed protects bank assets while pricing you out of asset ownership. You rent forever while they own forever. Wealth concentrates at the top. Your savings are losing value. You have money in a bank account, maybe $30,000 or $50,000, set aside for emergencies or retirement. That account pays maybe 1% interest if you are lucky. But real inflation is running 6 to 8%. Your savings lose 5 to 7% of purchasing power every year. Over 10 years, you lose half your wealth just by holding dollars. This is a direct transfer from you to banks. Your purchasing power declines while bank balance sheets stabilize. Your savings finance their rescue. And it happens invisibly through inflation rather than visible taxation. Let me give you specific numbers. If you're a household earning $70,000 per year and real inflation is 7%, you lose $4,900 in purchasing power annually. Over 10 years, that is $49,000. Almost a full year's income just evaporated. That $49,000 did not vanish into thin air. It transferred to people holding assets that inflate faster than the currency devalues, to institutions that borrow money before it loses value and repay in depreciated dollars later, to banks that get rescued with fresh money while you hold on to devaluing money. This is the mechanism. This is how bailouts cost you money, even though you never wrote a check to a bank. You pay through purchasing power loss. You pay through reduced savings value. You pay through asset price inflation that locks you out of ownership. The system is designed this way. It's extracted from regular people. It transfers to institutions. It concentrates wealth at the top. And most people never understand the mechanism, so they cannot object effectively. Share this with someone who thinks the system is fair, because we are not done yet. Let me show you why this guarantees future crises. Imagine you could walk into a casino, place any bet you want. If you win, you keep all the money. If you lose, taxpayers cover your losses. What would you do? You would bet aggressively. You would take huge risks. Why not? You cannot lose. You have unlimited upside and zero downside. This is exactly how major banks operate now. They make speculative bets, risky trades, leverage positions. When these bets pay off, executives get massive bonuses. Shareholders get returns. Profits are enormous. When bets fail, the Federal Reserve steps in, creates lending facilities, provides liquidity, prevents losses. The institution survives. Executives keep their jobs. Many keep their bonuses. This creates perverse incentives. Banks learned from 2008 that they will be rescued. They learned from 2020 that they will be rescued. Now they are learning from 2026 that they will be rescued. So, why would they ever become more conservative? Why would they reduce risk? Why would they act prudently? They would not. They cannot. Their competitors will take risks and generate returns. If they do not match those returns, shareholders will punish them. Executives will be fired. The market rewards risk-taking when the downside is eliminated. This is a moral hazard, and it makes the next crisis inevitable. Banks will keep taking bigger bets. Eventually, too many bets fail simultaneously. The Federal Reserve creates larger facilities, prints more money, inflation accelerates. The cycle continues until something breaks completely. We are watching the system destroy itself slowly. Each intervention makes the next crisis bigger. Each rescue makes the eventual collapse worse. Every kick gets heavier. The silver crisis is just one small example, but it shows the pattern perfectly, and the pattern is accelerating. Stay with me, because this next section reveals what happens from here. There are 3 possible paths forward from here. Each one affects you differently. Let me walk through all 3. Scenario 1, the Fed keeps printing. This is the most likely scenario. Silver prices stay elevated or keep rising. Banks cannot close their short positions. The Federal Reserve expands the facility from $17 billion to $30 billion, then $50 billion, then more. This path means accelerating inflation. Your dollars lose value faster. Groceries get more expensive, rent increases, gas prices stay high, your wages cannot keep up, your standard of living declines slowly but continuously over the years. The advantage of this scenario is no sudden collapse, no bank failures, no financial crisis, just slow erosion of purchasing power spread across the entire population. This is the path of least resistance. This is what authorities will choose if they can. Manage the crisis indefinitely through money printing. Hope something changes eventually. Scenario 2, banks forced to cover shorts. This is the market discipline scenario. Silver prices spike so high or margin requirements increase so much that banks must liquidate positions regardless of losses. This path means bank failures. Some institutions cannot absorb the losses. They become insolvent. Trading halts. Credit markets freeze. Other banks stop lending to each other because nobody knows who's holding toxic positions. Financial contagion spreads. This creates a recession, maybe depression. Unemployment rises. Asset prices crash. But eventually markets clear. Bad debts get written off. Institutions that survive are stronger. The system resets at more sustainable levels. This path is painful in the short term, but potentially healthier long term. It is also politically unacceptable, so it is unlikely unless circumstances force it. Scenario 3, rule changes. This is the government intervention scenario. Authorities change the rules mid-game to prevent bank losses. Maybe they force cash settlement instead of physical delivery. Maybe they suspend trading. Maybe they impose price controls. This happened in 1980. Silver hit $50 per ounce. Trading was restricted. Position limits were imposed. The market crashed. People holding silver lost fortunes. Short banks were protected. This path means rule changes that benefit institutions over individuals. Your contracts might be modified. Your property rights might be limited. Your investments might be forcibly restructured. This is also the confiscation risk scenario. The government could claim strategic necessity and requisition private silver at below market prices. Sounds extreme, but there is historical precedent from 1933 with gold. The most likely outcome is some combination of scenarios 1 and 3. The Fed keeps printing while authorities quietly change rules to limit bank losses. Regular people face inflation plus rule changes that protect institutions at individual expense. You cannot control which scenario unfolds, but you can understand them. And understanding helps you make better decisions about your own money. Here is what you need to understand. This is not just about silver. This is about the structure of the system, about who it protects and who it extracts from. The system rewards institutions. It punishes individuals. It concentrates wealth at the top. It distributes costs to the bottom. This is not accidental. This is design. Your decisions should account for this reality. Do not expect institutions to protect you. They will not. They protect themselves. You are on your own. This means holding assets that survive currency devaluation. Real estate, commodities, productive businesses, things that maintain value when paper currency loses value. This means reducing exposure to pure dollar savings that lose purchasing power. Keep enough for emergencies, but do not hold large amounts in cash or bonds that pay below real inflation rates. This means understanding that the official numbers lie. When the government says inflation is 3%, but your costs are rising 8%, trust your experience over their statistics. This means recognizing that the next crisis is coming. The pattern guarantees it. Be prepared. Have savings. Have skills. Have options. Do not be caught assuming everything will continue smoothly. Most importantly, stop expecting fairness from a structurally unfair system. Stop expecting protection from institutions that exist to protect themselves. Stop trusting authorities whose primary concern is maintaining current arrangements regardless of cost to you. You cannot change the system, but you can protect yourself within it. That starts with seeing clearly. Subscribe, because this pattern will repeat, and you need to know when it happens. Let me bring this together. 72 hours ago, the Federal Reserve committed $17 billion to rescue banks that bet wrong on silver. This happened silently. No announcement, no vote, no public input. China engineered a trap using export bans and price manipulation. American banks walked into that trap. Now they face losses they cannot absorb. The Federal Reserve stepped in to prevent collapse. But here is what this really means. Banks gambled. China trapped them. The Fed printed money. You pay through inflation, your grocery bill, your rent, your savings. All are losing value to fund the bank rescue. This is not new. This happened in 2008. This happened in 2020. This is happening now in 2026. Same pattern, same playbook, same people paying. Private profits, public losses. Every single time. The moral hazard is complete. Banks learned they cannot fail, so they take bigger risks. The next crisis will be larger. The bailout will be bigger. Your costs will be higher. 3 scenarios are possible. The Fed keeps printing and inflation accelerates. Banks are forced to cover, and markets crash. The other government changes the rules to protect institutions at your expense. Most likely is a combination of printing and rule changes. None of these scenarios benefits you. All of them extract from you. The system is designed to concentrate wealth at the top while distributing costs to everyone else. You cannot change this, but you can see it clearly. And seeing clearly lets you protect yourself, hold real assets, reduce pure dollar exposure. Prepare for the next crisis because it is coming. I'm tracking Federal Reserve balance sheet data weekly. I'm monitoring COMEX silver inventories. I'm watching Shanghai's I premium levels. When the next 17 billion appears, when the next crisis emerges, I will show you exactly what is happening and what it means for your money. Subscribe right now, turn on notifications, because this pattern will repeat. The only question is whether you see it coming or whether it catches you by surprise. The choice is yours. You can ignore this and hope everything works out, or you can pay attention and prepare. 72 hours ago, they quietly created $17 billion to rescue banks. What are you going to do about it?